how the Fed move to neutral will lift world trade. In our previous discussion on the Federal Reserve, we suggested that the deterioration in the US labour market would move the Fed towards an easing path. We have now seen in the most recent meeting the Fed cut rates by 25 basis points at the September meeting. As a result, the effective Fed funds rate has fallen from 4.35% to 4.1%. Our model of the Fed funds rate suggests the effective funds rate should move all the way down to 3.35%. At that level, the model indicates that monetary policy would be neutral. The summary of economic projections from the Federal Reserve members and the Fed presidents also tells us that the Fed funds rate should fall to a rate of 3.6% by the end of 2025 and a level of 3.4% in 2026, which is effectively our rate of 335 basis points. We believe that the Fed funds rate will fall to our target of 335 basis points by the end of the first quarter of 2026. The challenge then remains the gradually weakening US labour market. The summary of economic projections expects US unemployment to rise from 4.3% in September this year to 4.5% in December of this year. Unemployment is then projected to fall very slowly to 4.4% by the end of 2026 and 4.3% by the end of 2027. These expectations would suggest one of the least eventful economic cycles in recorded history. We should be so lucky. In the short term, it is likely that the Fed will cut the effective funds rate to 3.4% by March 2026. This move to a neutral stance will have a significant effect on the world trade cycle and on world commodities. The US dollar remains the principal currency for financing trade in the Indo-Pacific. Lower US short-term rates will likely generate a recovery in the trade of manufacturing exports in the Indo-Pacific. This in turn will increase the demand for commodities. The Fed's move to neutral monetary policy will generate benefits well beyond the US.